Buying a first home may feel exciting, also intimidating, as this is probably the biggest financial purchase you'll ever make in your life. First-time home buyers often get pulled in so many different directions on guidance from parents, friends, neighbors, and others. So today, I want to break down the 10 essential steps of buying a house. These come directly from a mortgage lender, investor, and homeowner myself. Hi, I'm Lisa, your local lender here in Nevada. I've helped many home buyers finance their homes. First things first, you must know your budget. If you overspend on a house, you run the risk of becoming a house poor, spending most of your income on housing. The first step to buying a house is to plan your finances for home buying success. I like to divide this up into 3 separate categories that are going to be essential to setting you up for success: savings, income, and credit score. When I talk about the savings needed to buy a house, I'm talking about the money that you'll set aside specifically to cover your down payment and the closing costs, or fees associated with getting a loan and buying your house. Down payment options for major loan programs range from 0 all the way up to 20+%. Now, something I want to be very clear on early in this video is FHA loans are not just for first-time homebuyers. In fact, anyone can use an FHA loan. While it's true that these loans are often a good fit for first-time homebuyers, the FHA loans are more so ideal for buyers looking for low down payment options as little as 3.5%. Flexible income and credit guidelines in comparison to conventional loans. But keep in mind, when you put only the minimum down of 3.5%, you need to pay mortgage insurance. Less than 10% down. In this case, putting 3.5% falls into this category. You need to pay your mortgage insurance for the life of the loan. But when you put at least 10% and more, you'll only need to pay mortgage insurance for the first 11 years of the loan term. The only way to eliminate mortgage insurance is to refinance into a conventional loan or another type of loan that doesn't require mortgage insurance. How about zero down payment, aka down payment assistance or DPA loans? Using a DPA loan can be beneficial for some buyers, but there are also several reasons why it might not be the best option for everybody. Here are some reasons why you might reconsider using a DPA loan. Some DPA loans are structured as second mortgages that need to be repaid, while others might require repayment if you sell or refinance your home within a certain period. This can add to your financial burden. Higher interest rates. DPA loans often come with higher interest rates compared to traditional loans. Even if your lender offers you the same interest rate as traditional loans, you'll still have to finance your down payment portion. So this can result in higher monthly payments and more interest paid over the life of the loan. Let's talk about additional fees. These programs may have additional fees that can increase the overall cost of your mortgage. Some programs charge origination fees or other costs that can add up. So I wouldn't plan on using a DPA program right off the bat because the more money you've saved for your purchase, the better off you're going to be financially. Keep in mind, to qualify for the 3.5% down payment, you must have a minimum credit score of 580. If your credit score is between 500 and 579, you may still qualify for an FHA loan, but will need to make a higher down payment of at least 10%. Now, that 3.5% down payment does not factor in your closing costs. I would go ahead and also budget an additional 3% for your closing costs. So let's just say as a benchmark, what you would want to do is save up about 6.5% to 7% total of your purchase price to cover the down payment and closing costs. Keep in mind, closing costs are still going to be by default your responsibility as a buyer. It's not always the case that those can be negotiated and paid for by the seller. Now let's talk about income. That's one of the most important factors when buying a house. Your lender wants to see your ability to pay back the loan. It helps make you a creditworthy borrower if you don't have a large employment gap in the last 2 years, because they want to see your income will be stable. But what if you have less than 2-year employment history? For conventional loans, as long as you are salaried or full-time, even if you're currently hired in a different line of work, your income still may be considered as an acceptable income. In terms of a credit score, a great benchmark is to aim for 620 or higher. The higher the credit score, the lower the interest rate you may get. This also applies to lowering the mortgage insurance if you were to take on the conventional loan. To set yourself up for ultimate success, I would encourage you to aim for a 720 or possibly a 740. Now that you feel a lot more confident to start the home buying process financially, you're going to move on to step 2, which is hiring a realtor to represent your best interests as a buyer, while sellers are also going to have their own agent to represent them, negotiate against you. When you're trying to find a great agent, you're going to want to try to find someone who is very familiar with the neighborhoods and the cities that you're looking. One important question that homeowners often overlook is, does this home fit my lifestyle? Even a home that is beautiful, spacious, and affordable may not be right fit for you if it doesn't align with your daily life or activities. Once you've hired a realtor, the next step is to get pre-approved for a loan. This is step 3. Your realtor likely knows a few good lenders and will give you a recommendation if you ask for one. However, there's no obligation. You're free to stick with whichever one you choose. Realtors cannot receive a kickback for giving you a recommendation for a lender. That is completely illegal. But I highly recommend using a local lender, because when you work with a large bank or online lender, you're just another number. It is extremely challenging to get a hold of someone, while real estate transactions are really time sensitive, and that's going to be very frustrating. But when you work with a local lender, they'll get to know you and your needs. They'll be invested in helping you find the right home and in getting you the best loan possible. When I help my clients, I picture their future financial goal because real estate is a long-term investment. Once your lender understands what your goals are, the very first thing you'll be asked to do is fill out an online loan application, most recent 30-day pay stubs, 2 years of tax returns, 2 years of W-2s or 1099s, and your most recent 2 months of bank statements. Lenders also do a hard credit pull to see not only your credit score, but also what's on your credit report. Okay, let's go back to those documents mentioned earlier. So you're going to prepare those documents in formats like PDF files and send them to your lender, either through a lender's website portal, share them in the cloud-based storage service, or via email with PDF attachments, and keep the originals. Once you've got pre-approved, it is time to move on to step 4, which is to start house hunting. And this is the most fun part for most people. Have a thorough conversation with your realtor about what kind of house you're looking for. Remember to make a needs versus wants list. This is very important. Now that you have a pre-approval letter, and this is like a boarding pass, your offer is going to be strong when you find one that you want to make an offer on. And that's step 5. Once your offer gets accepted, then you're going to have to start moving very quickly. You're going to have to send the earnest deposit money to the escrow account to show that you're serious. And it'll be held until the closing, and this is step 6. So now let's move on to step 7. You'll pay for an inspection for a report on the overall health of your property. Almost at the same time, you'll also pay for an appraisal fee. These 2 fees must be paid outside of escrow, meaning pay up front. So the appraisal can come back in 3 different scenarios. 1, the house can appraise at your sales price. 2, it can come back with a higher value than the sales price on the contract, meaning you could potentially have some built-in equity. So this is going to be your favorite one as a buyer. 3, the appraisal could come back below the value that you are under contract for the house for. If that's the case, you may need to do a little bit of a renegotiation on your contract, which your realtor can do on behalf. Reasonable sellers may come down to the appraised value so that the transaction could keep moving forward. If not, you're going to have to pay for the difference, which cannot be financed because lenders only lend money for what it's worth, not based on what sellers want. Let's move on to step 8. If you've received a clear to close status on your mortgage loan, you are very close to the finish line. Clear to close means the underwriters approved your loan documents, and this must happen at least 2 days prior to closing. Step 9, final walkthrough. This is going to be your opportunity before closing, usually done maybe the day before closing. You go back to the house and you check up and see if the house is still good and still in the same condition before the seller signs off. Now, your lender will be sending you your initial closing disclosure, or ICD, 3 business days prior to your closing date. And this has all your final loan numbers on it, including your interest rate, your loan amount, your cash to close, meaning the amount of money that covers your down payment and your closing costs. So this is the actual time for you to take a careful look over your closing disclosure. Make sure that all the figures look correct. Nothing should be unexpected, and you're well prepared to go to your closing. Finally, step 10, actual closing. Your title/escrow company will contact you to schedule an appointment for signing the final closing documents, which typically happens at the title company office. But if you're willing to pay extra fees for a mobile notary, they could come to you. It can be your current residence or a coffee shop nearby. You're going to have to sign the documents by hand, and don't forget to bring your ID. And then you'll have a writing instruction to send money to the title company. Now you've done signing the final documents and sending the cash funds to close. Once the deed has properly recorded with your county recorder, legal ownership of the property transitions from the seller to you, which means you can now get the key to your new house. Congrats, you did it.